Hello and welcome. This is the first movie in the series of videos we have for Finance 2, and it's an introduction of these movies. We're going to have usually quite a lot of examples to help you understand some of the many terms that we use in the course. Also, when possible, we're going to refer to StockTrack to help you use the material in the course in the game that you're also going to participate in, I hope. So today we're going to give some examples on what financial markets are and why we need them, some way to distinguish between real assets and financial assets, a little look about the investment process which you need to consider when you start buying things in StockTrack, and also we're going to look a little bit at stock market indexes. So if we start by looking at a company which has a small aircraft that drives a few passengers wherever they want to go. Maybe one day they get a business idea or a vision that they would like to actually grow and have a big plane so they can take a lot of customers to different places, so they want to get larger. To purchase a plane like this, you probably need quite a lot of money, and getting it by using this small plane, flying a single or maybe a few customers, will probably take more time than this entrepreneur has. So the problem for him is that he doesn't have enough money to actually make this business idea come to life. Well, what can he do then? Well, that's when he can turn to the financial markets and try to get finance from there. So we have both equity capital, which means people purchase ownership into the company, and we have the debt market where you can get loans or that kind of financing. Usually, this business idea is meant than companies that get. So you can have a company that would like to make an investment which they currently do not have cash for, or maybe they will never get it. In this case, when going from a small aircraft to a large company. Then you usually need to go to the financial market to get financial support. So then it's quite intuitive to ask yourself, what is then a real asset and a financial asset? So a real asset is something which is used to produce goods or services. So, for example, we could ask the question, what is needed to produce timber? And now I'm not an expert in producing timber, but at least I think you need a chainsaw or something else to cut down the trees. You probably need a tractor or horses, perhaps, and maybe trucks to transport the fallen wood from where you cut it down. And then probably, maybe you want to ship it to America or some other place. Then you might need a cargo vessel to transport it efficiently. So these are, of course, not all the necessary inputs, but all of these are useful or needed. They can at least be used to produce timber, and therefore they are what is called as real assets. On the contrary, we have the financial assets. They, by themselves, they don't actually produce anything. But, like we said, I might need resources in order to buy this aircraft, and people aren't just going to give it to me. I need to give them something back, so they want to have some kind of proof that they actually are entitled to some of the proceeds from the future the future income of my real assets. So we have, for example, equity capital, such as common stock or preferred stock, which are then represent ownership in a company, and we have debt, such as bank loans or bonds, which represent that you lent money to usually a company and are entitled to fixed income streams. And just to give two examples, there are very many, but these are just two. In a few days ago, Autoliv announced the issue of a long-term bond, so they're going to the debt market to get money, whereas a little bit more than a month ago, SAS announced the issuance of preference shares, which means that they wanted more equity in the company. Okay, so let's start with the investment process. This is going to be very important for you when you use StockTrack. And we have basically two different parts that you need to consider. One is the asset allocation, and one is the security selection. So let's start at the asset allocation. What is that? Well, this is how it can look in StockTrack. You're going to report something like this, an asset allocation pie. But here, I've decided that I want to spend 74% of my money in stocks, I want 23% in bonds, and I want 3% in the money market. These numbers are, of course, just arbitrary. Please do not use exactly those numbers for your investment. Make up your own mind. but this could be, I could do it like this. So I decide on how much I want in stocks, how much I want in bonds, and how much I want in money market. Okay, so what do I do next then? Well, I need to place this money somewhere. I cannot just invest it in stocks. I need to choose which stocks I want to invest it in. So of these 74%, I place some money, in this case in Google, some in travelers companies, some in Intel, Ericsson, and Microsoft. And these are then from the 74% that I originally decided should be in stocks. So I know how much money I have, then I portion it out in different companies and different securities. And I do the same for bond and money market then. But this is called top-down, an investment process called top-down. I could also go the other way around. So instead, I start with the security selection. I decide which companies I would like to invest in. So for example, I find out that I think Google and all of these are very interesting. And especially I appear to have a love for Ericsson and Microsoft and believe that they have the most potential. So what I do here is I don't decide from the beginning how much to spend on stocks. I look and find, okay, so this stock seems attractive to me for whatever reason. And I want to buy some in that, and then I find another stock which is also attractive. And maybe perhaps I find a bond or a money market fund or something like that, which also appears to me to be attractive. So instead of deciding from the beginning how much should be in stocks, I look at which securities appear to be cheap to me or to have a good price. And these are the ones I buy. And then when I've done that, I can trace out how much I have invested in stocks. So from this, I can go see, okay, I invested so much money in Google, so much money in Intel, so much money in Ericsson. And it turns out then that I invested 74% of all my money in stocks just by picking out these. And of course, by now, I don't really know how much I've invested in the bonds or how much I invested in the money market, because here I only chosen to invest in stocks so far. And I don't know how much will end up in the bond, perhaps nothing or perhaps the rest. I don't know that yet. And on the contrary to top-down, which we discussed in a minute ago, this is called bottom-up. So you start from the security selection and you go up to the asset allocation. That will just eventually turn out to be whatever it is. Okay, so now to a completely different question. Sometimes you can hear on the news, for example, that the stock market increased by 2% today. Okay, that's all good, but what does it really mean? Does it mean that all stocks increased by exactly 2%? Probably not. It's probably not so that all stocks increased by exact same amount, because stocks usually don't act that much together. Does it mean that stocks on average increased by 2%? Yeah, it's possible. It could be so that stocks on average increased by 2%, but that is still not really a satisfactory answer to me, because what do you mean by an average? Would you give the same weight to a company such as SAS, which is fairly small in the market? Would they get the same weight as, for example, H&M, which has a very large fraction of the market in Sweden, measured by market value then? Should they be given the same weight? Or is it a weighted average we're talking about? So the H&M, which is bigger, gets a bigger part of this return, whereas SAS doesn't. So how you weight also matters. What is an average in this case? But you could also ask yourself, are all stocks included in the computation? I mean, is every company in the entire Sweden included? Or maybe that's not realistic, but are all listed companies included? Again, probably not. The most common market value or index in Sweden is called OMX S30 and consists of the 30 biggest companies. So everyone else, you don't care about them. They might have gone well, they might have gone bad. We don't know that, but usually they follow this index quite well, so it's a good description, even though not precisely correct. At least it gives you an idea of what happened in the market today. And we're now going to look at 3 different ways of computing indexes that weight differently, and in this case, yeah, they include whatever stocks you choose to include. So we're going to start by something called a price-weighted index. And the idea of a price-weighted index is that you imagine an investor who owns one of each stock. So, for example, let's say that I have a low salary and I can only buy a few stocks every month. I can only invest a little bit of money. But I know, because I've taken Finance 1, I know that diversification is good. So if I buy several companies, I will reduce my risk, hopefully at least. So therefore, I always purchase, I use my money on many different stocks, and I purchase a single share of each company, so that eventually I will own one share in every company in Sweden. And then to keep track of how I would do, or maybe how I will do when I gotten one of each share, I could produce something called a price-weighted index. So this index would be correspond to me having one of each stock. So when I do get to that point that I have one of each, this index will tell me how I would have done by then. So how do you compute it? Well, now we take a very, very small market, which only consists of 3 stocks, because it would be too much for me to write otherwise. So we have 3 different stocks. They have an initial price given here, and they have ending price given here and the day's return. And now we want to compute then the index value. So how do you do that? Well, you do it like this. You take the price of the first stock, Handelsbanken, it's 320. You add the price of H&M, 280. Then you add the price of Millicom, 642. And you divide this by 3. So you divide it by the same number of shares that you have in the beginning. And this turns out to be 414. So that's the index value at the beginning of the day. And then we would need to know the ending price as well to find out how it went. And to do that, you do the same computation, and you find out that the index value at the end of the day is actually 420. So the index went up, in this case by 6. And how do you then compute the return? Well, I've already written what the return of the individual stocks are. So, and this is computed by taking the ending price, 328, minus the beginning price, 320, divided by the beginning price of 320, and that is equal to 2.5% in this case. For the index, the corresponding computation then is 420 minus 414 divided by, not by 3, divided by 414. And this is then equal to 1.45%. So what we can note here is that the return of Handelsbanken is 2.50. The return of H&M is 1.46. The return of Millicom is only 1. And the index return is actually lower than both Handelsbanken and H&M. So why is it so low compared to, for example, Handelsbanken? Well, because we own a single of each share, it means that I've invested the main part of my money in Millicom. Because this is the most expensive share, so if I only own one of these, one of this, and one of that, then I have invested 320 in Handelsbanken, 280 in H&M, but 642 in Millicom. So obviously, the return of Millicom affects my return the most. And since Millicom in this case was the lowest one, the return of my whole portfolio, or the index in this case, is fairly low compared to the rest. Also, you might then run into complication with splits, and that you will have to deal with during the calculation exercises. Okay, so a maybe more sensible way of weighting is that you don't look at me, the low-paid guy who can only purchase a single share of each company, but actually you should give more weight to the companies that are actually big, not one with a high price of a single share then. So, for example, H&M is the biggest company in Sweden, then they should be given a quite high weight, not as in the last case. And then you have something called a value-weighted index, and what you look at then is basically how much did the value of the whole market change during the day or the month, or whatever you look at. So to do that, we need to compute what is the value of the market. And to find the value of the market, we simply sum the value of the individual companies, but that we need to compute. So here we have the initial price of Handelsbanken and the number of shares. Of course, it should be 624 million, I think it is. But I reduced the zeros a little bit. So to compute the market capitalization, or the market value, you take 320, which is the price per share, times the number of shares, 624, and then you get the market value of 199,805. In the case of H&M, you take the price, per share, 280, times the number of shares, 1,461, and you get the market value of 409,518. And the same for Millicom, the price per share times the number of shares, and then you get the market value of 62,226. And to get the value of the whole market, you simply sum these three, and you get that value in total to 671,549. As with this index, as well as with the other one, we need to compute the market value at the end of the day to compare it to the beginning of the day, which we did here. And you compute it in the same way, but with the ending prices, of course, instead. So I've done that here, and we see that the market value increased to 683,000. To compute the return, we do the same way as we did before. You take the ending value of the market minus the beginning divided by the beginning, and then you get the market return of 1.73%. So we see that this number is actually higher than the one we got previously, and that's because Millicom now gets a smaller weight because they have a smaller market capitalization. They had a high price per share, but they had quite few shares compared to the other. So therefore, this one is not as important for the index return. The third and last index we're going to look at is called equally weighted, and it corresponds to investing the same amount of money in each share. So instead of buying the same number of shares, I decided to invest 100 crowns in H&M, 100 crowns in Ericsson, and 100 crowns in Millicom. And then the return, since I invested the same amount in each, the return will simply be the normal average. So to get the return of an equally weighted index, I take the return of Handelsbanken, 2.50%, plus the return of H&M, 1.46%, plus the return of Millicom, 1.01%, and then I divide it by 3 to get the return of 1.66%. So this is also slightly different from the two others. Okay, so that's it for today. I hope you will not struggle so much with these index computations anymore. But remember that when you do hear someone saying how much is actually, the market did increase by 2% today, at least reflect on what does it mean, how do they measure it. Thank you.